Good morning, this is May Valensky with Driving Markets. Wow. Okay, so let's just have a look at what the action was yesterday and what is going to be driving markets today. As I've said since the beginning of the year, that inflation is rampant. Inflation has just got out of control and the banks are well behind the curve. The central banks are well behind the curve on interest rates and on inflation. They did say that they expected that by April, May, the inflation would be under control. And I was already stating in January, it's out of control and there's no way it's going to be in control by April. So the Fed minutes came out yesterday and several members of the Fed committee stated that they need to raise interest rates by 50 basis points. I've already been saying that since January, and I've been calling interest rates in the States at around about 5% by the end of the year. That was considered a maverick, an extreme opinion, where every investor and every bank analyst looked at interest rates of maybe 1 to 1.5% for 2022. Cancel that out. It's not going to happen. Interest rates are going to go to 5% in the States. If you look at 30-year mortgage rates, 30-year mortgage rates now are well above 5%, and that has sunk the mortgage market. Mortgage applications dropped by 6.3% in 1 month. That affected shares of house builders, home builders, and banks and other investment funds. They all went down yesterday. The biggest victim, or the biggest nervous index of interest rate rises, is the Nasdaq. I've been saying that since the beginning of the year. We're not talking about a day trade. A day trade, you can catch it either direction due to volatility. I'm talking about trend over the next few weeks, over the next 8 months to a year. The trend on the Nasdaq will be down. On the back of what? On the back of higher inflation and higher interest rates. The 10-year Treasury went to 2.66% yesterday. That's the highest it's been in nearly 4 years. And remember, I talked to you also about the inversion of the 2-year and the 10-year. That's already happened 3 times in the last week. That goes on for 90 days. That is a sure sign of a recession. What else happened? Deutsche Bank. Deutsche Bank came out yesterday. Wow, Deutsche Bank, amazing analyst. They said that America is definitely going to go into recession this year. That sent the DAX down nearly 3% intraday, and it clawed its way back a little bit to close down 2.5%. So you've got to look at interest rates and inflation and where we're likely to be going, and it's only going to go up. We've got the geopolitical impact of wheat, barley, soya, fertilizer. That's all going to be impacted by the Russian war with Ukraine. It's going to shorten supply and it's going to frustrate supply even further. Look at oil. Oil yesterday dropped below $100 a barrel. Why? Because the Europeans and the US are opening their strategic reserves, or called emergency reserves, and that's sent the price of oil down. But I want you to make a note. Oil is not going to stay down. It's going to go up. The only way it's going to go down if it breaks the uptrend, and there's a slight opportunity for breaking the uptrend, and that's based on if the world's going to go into a recession. If the world goes into recession, then the demand for oil naturally will go down. However, I believe that the supply issue with oil is so great is that the oil is going to creep back up to $150 a barrel, at which there'll be no alleviating of it through the strategic release of the reserves by the US or Europeans, because there'll be no strategic reserves left. So at the moment, oil's dropped below $100 a barrel and likely to go further. Looking at shares like Microsoft, Apple, Tesla, they all came off yesterday by between 2 and 3%. Also, Twitter slightly came off. However, Twitter, in my opinion, is going to be an exciting share to watch purely on the basis of, purely on the basis of that Elon Musk has now been elected to the board, and he is a dynamic boss. He's a dynamic CEO. I love him, so I want to be very, very clear. I'm a big fan of Elon Musk, and I think he's going to turn around Twitter. So that is a share to watch. Some of my viewers are saying, can I give more stocks and more shares input and be more analytical? I can't. Why? Because I only have 5 to 6 minutes on driving markets. Otherwise, you get bored, and today's attention span of the human being is more or less around about the 30-second to 1.5 minute span. If there is enough attraction from the audience to give much more deep analysis, then I'm willing to do it. However, the idea of driving markets is to give you a quick summary. So let's just wrap up where we're at. So I see the yields on the 10-year bonds going higher. I see inflation going higher. I think inflation is not yet peaked. You've still got all the supply issues. I think interest rates are going to go to well above 5% just in the States. So that's my call. Make a note of it. I already said it back in January. I'm stated again in April. Interest rates in the States are going to be at 5%. I see the Nasdaq falling significantly, not on a day trade, but overall trend. It's definitely entering bearish territory at the moment. I think Tesla also has probably peaked at this level, and there could be some significant profit taking on Tesla. Bitcoin was hammered yesterday. One of my viewers does not like the word when I use hammered, so I'm going to say it again. Bitcoin was hammered yesterday and looks like it could be on a downtrend. It went down over $2,000 yesterday, and overnight it's down over $600. So you could see Bitcoin floating down to around about the 35,000 level. At that level, 32, 33, 34, I'm a buyer. Looks like a good support level unless that is broken. But at the moment, looks like Bitcoin is a sell. There's not much more I can talk about now because I've passed my 6 minutes. So this is Mayor Valensky with Driving Markets. You can catch me on LinkedIn, YouTube, Instagram. Subscribe. Have a good day. Good luck. Keep on smiling.